Aloha students, and welcome to the lecture on Chapter 8. In Chapter 8, we're going to be talking about standard costing. Standard costing is using, standard costs are like benchmarks for labor, materials, and overhead. It's the amount of those things that you plan on using. So it's ahead of time. It's the amount that you set a goal for the quantities and dollar amounts used of each of those things that enter into uh, manufacturing something or providing a service. These standard costs are based on estimated amounts, and they're based on expected levels of performance. So it's just to put it in basic terms, it's how much materials you should be using in producing your product and how much labor you should be using and how much that labor should cost in making your product. A standard cost variance is after the end of the period. You see how much it actually cost you versus how much it should have cost you. And again, the standard cost is how much it should have cost. Again, for variances, remember that an unfavorable variance is if the actual cost is more than what you planned for. That's the standard cost. A favorable variance is if the actual cost is less than you expected. Okay, standard costs variances are important because based on management by exception, where you focused on those things that are different than what you expected, you use standard costing to identify those things that need attention and those things that are different from what the expectation was. And again, that's what the standards are the expectations. Okay, so setting these standards, there's two levels, I guess, of standards. Practical standards are those levels that are attainable and that are reasonable. And with a little bit of effort, you can reach those standards. Ideal standards are, if everything was perfect, then these are the goals we would attain. So ideal standards are generally unattainable because they're almost impossible to meet, because there is never such thing as perfect conditions. And as the slide indicates, ideal standards. So if you set goals based on ideal standards, it's kind of encouraging because you can never meet the standards because, again, they're based on perfection. So it's a detriment as far as employee morale, because if you have goals that nobody can ever meet, that's going to lead to employees' dissatisfaction. Okay, so let's take a look first at direct materials standards. Okay, so two different aspects of direct materials standards. One is the price. So how much do you pay for the materials that are used in production? Usage, on the other hand, it's how much materials are used to make one unit of product. Okay, so the standard material cost for one unit of product is the price that you pay for one unit of materials, the standard price, which you think you should pay, times the standard quantity of materials used in one unit of product. Okay, so it's supposed to cost this much per unit, and you're supposed to use this many units of material. That's the standard material cost. With respect to direct labor standards, there's two, again, components of that. The rate, standard rate, is how much is planned, or what's the goal on how much you pay per hour for labor. Efficiency variance is how much time it should take to produce 1 unit of product. So the standard labor cost for 1 unit is what you're paying, the standard wage rate for 1 hour, so what you think you should be paying, or the goal of how much you're supposed to be paying for an hour, times the standard number of hours for 1 unit. So how long should it take to produce 1 unit? What's the goal for how many hours it should take for 1 unit of product? Okay, so standard wage rate times the standard labor hours is the standard cost for 1 unit. Okay, so the relationship between a standard and a budget is standards are generally the cost that is expected for a single unit of product. A budget, on the other hand, is the cost for all of those units put together. Whenever you hear standard, it generally refers to a 1 unit of product. How much should it cost to produce 1 unit of product? Budget is how much will it cost in total for all the production that we have. You read in the book the advantages and disadvantages of standard costing. So again, you can just look at this on your own. A couple of highlights there though. Advantages is that you improve cost control, so you can have a more tight control over how much it costs to produce your product. Disadvantages is it's negative exceptions. Anytime you have a management by exception, you're looking at only those things that are not within what you expect it to be, so it tends to be more of a negative kind of management style. So if things are what they're expected to be, then you don't really pay much attention to them. So there's no positive reinforcement. So as you can see here, the emphasis on negative exceptions may impact morale because it's always looking at the negatives and not so much the positives. Okay, so here's a general model for variance analysis. And again, remember, variance analysis is looking at what actually happened versus what you expected to happen based on the standards. There's 2 components of cost variance analysis: price variances and quantity variances. And so we'll see there's 2 different things that we analyze through cost variances, and the structure though is the same for both. Price variance is the difference between the actual price paid and the standard price paid. So how much did you actually spend on the materials or labor or whatever we're looking at? How much versus how much we were supposed to have paid. Okay, so that's price variance. Quantity variance is the difference between what we actually used and how much we should have used based on our standards. Okay, and we'll see the specific examples of these in a second. So this is a template that I like to use. You don't have to use this. You can just use formulas, as we'll see. But I like this chart. Notice that the left-handmost column is the actual quantity times the actual price. The right-hand column is the standard quantity times the standard price. And the middle column is always going to be actual quantity times your standard price. So once you have these 3 columns with the 3 numbers in them, the difference between the first column and the middle column is the price variance. The difference between the middle column and the far right column is the quantity variance. Again, down here it kind of reinforces the concept of standards. Standards are what should have been paid and what should have been used. Okay, your goals. By the way, if you take the difference between the far left column and the far right column, that gives you the total variance. Okay, and we'll see this chart again, but I like to use this particular chart. Okay, so here's an example of direct materials variances. Okay, so this company makes zippies, and the standard is 1.5 pounds of material for each zippy made, and they want to pay, or they have a goal of paying $4 per pound of that material. So these are the standards. Again, standards are developed ahead of time and are like a goal to try to achieve. Okay, so the actual production records showed that 1,700 pounds of materials were purchased for a total cost of $6,630, and those 1,700 pounds of materials were used to make 1,000 zippies. Okay, so again, here we have the standard price, $4, and the standard quantity, 1.5 pounds each for each zippy. Here's the actual, and I believe well, let's go back. Okay, so using our chart here, material variances chart, the actual quantity times actual price is your price variance. The middle column, actual quantity times standard price. You take the difference between the left and the middle columns, that's your price variance. If you don't like to use this chart like this, you can use a formula, and here's the formula here. Price variance equals your actual quantity times the difference between actual price minus standard price. Likewise, usage variance is your actual quantity times standard price, the middle column, minus the standard quantity times your standard price, the right-hand column, and that difference gives us a usage variance. Again, if you don't want to use the table, you can just go directly to the formula here, and the formula for usage variance is your standard price times the difference between actual quantity and standard quantity. So actual quantity minus standard quantity. That's take it, that difference, multiply by the standard price, that gives you the usage variance. Okay, so again, you can either use this table here or just go directly to the formula. And it kind of it depends on which you feel more comfortable using. They're both going to give you the same answer, obviously, because this is just a derivation of the table. Okay, so either way, using the actual numbers that we saw. Okay, remember the left-hand column is actual quantity times your actual price. The actual quantities in this table are the total quantities for the amount of units that we made. Back in the problem, tells us we used 1,700 pounds of material. So that's the actual quantity that goes into this formula. And again, remember, this is in total. The quantities are in total. The actual price, $3.90 per pound. The way we got that was it cost $6,630 in total. We bought a total of 1,700 pounds. If you do the division, that works out to $3.90 per pound. Okay, so if you multiply those out, you'll get that 6,630. The standards, the far right column, we were given that 1,500 pounds was the standard because 1.5 pounds each for each unit. We made 1,000 units, so we should have used 1.5 times 1,000, or 1,500 pounds. That was our standard. Here's where we get that standard. And the standard price, or what we wanted to spend per pound, was $4. Okay, and again, that was given to you here. Okay, so that turns out to be $6,000. Then the middle column is the actual quantity, which we get from here, times your standard price, which we get from over here, $4 a pound, gives us $6,800. Now, the way to get the variance is you take the right column, subtract the left column. So in this case, the price variance is the difference between the left column and the second column, the middle column. So 6,800 minus 6,630 is 100 is a positive 170. If it's a positive, that's a favorable variance. That's a good thing. The difference between the rightmost column and the middle column is the quantity variance. So 6,000 minus 6,800 gives you a negative 800. Therefore, it's an $800 unfavorable difference. Okay, and again, that favorable or unfavorable is important in variance analysis. This slide doesn't show it, but the total materials variance is the difference, again, between the outside columns. So $6,000 minus 6,630 gives us $630 negative. Therefore, that's a unfavorable difference. So $630 unfavorable difference. So that's a total materials variance. By the way, if you add these, the price variance and the quantity variance together, you'll get the same total variance. Okay, so notice the 800 unfavorable, so that's minus 170 favorable or positive, you'll get the same negative 630. Okay, so that's using the table to figure out materials variance. Let me go back. Again, if you were to use the formula that you see here, first thing you do is take the actual price minus the actual standard price. Actual price $3.90, standard price $4, so that's a negative 10 cents. In the parentheses here, negative 0.1. Multiply that times the actual quantity. Actual quantities 1,700. So the 1,700 times the negative 0.1 gives us this 170 favorable. And if you're using the formula here, it's going to kind of be weird because a negative value for this calculation means it's a favorable variance. Actual price is less than the standard, that's a good thing, so it's a positive. So a negative number is favorable, like we have here. Okay, so the usage variance, standard price times your actual quantity minus standard quantity. Looking at the amount within the parentheses, the actual quantity is 1,700. Standard quantity is 1,500, so that's 200 in the parentheses. Standard price is $4, so 200 times $4 is 8,000. Positive number, positive 800, sorry. 800 positive number means it's an unfavorable difference. Okay, so you can, again, either use the table as they do here on this slide, or simply go straight to the formula here to calculate the variances. Okay, and you're not given a formula, but if you add the two variances together, you'll get the total materials variances. Okay, so the total material variance is the combination of the price variance plus the usage variance. And don't forget, if they have opposite signs, one's favorable, the other's unfavorable, you're subtracting one from the other. Okay? It's basic math. Okay, so those are materials variances. Don't worry about the journal entries. Okay, that's not necessary, in my opinion, for this course, the level of this course. If you were accounting majors, then we would definitely get into these journal entries. Okay, but for this class, don't worry about journal entries. Okay, so we've computed the materials variances. Now we look at the labor variances. So this same company has the standards of 1.5 standard hours per zippy. So that means each zippy should take 1.5 hours to make. And our goal, or our standard, is to pay $6 per hour. This is either old or it's in another state that has a much lower minimum wage, because that's way low. Anyway, so the actual records showed 1,450 hours were worked. The total cost was $8,990, and they made 1,000 zippies. Okay, so just like before, let's take a look at again the labor rate variance analysis. It's basically the same structure that we saw for materials variances, only we just call them different things. It's not price variance, it's rate variance, and it's not, the usage variance is not usage, it's efficiency, which is exactly the same thing. Okay, so the same formulas, the same structure for the different columns. So looking at the actual numbers, the actual hours, 1450. That's indicated in the problem here. 1450 hours were actually worked by our employees. The actual rate was 620, and that's the total labor cost divided by the total hours, and that'll give us the 620 an hour. If we do the multiplication, we'll get that 8,990 that's in the problem here. The middle column, actual hours, again, 1450. Standard rate, the standard was we wanted to pay $6 an hour. The right-hand column, standard hours, the 1,500 standard hours, 1.5 hours each times 1,000 that we made. So that we should have used 1,500 hours. That's this based on the standard of 1.5 for each one we made, and we made 1,000. So the 1,500 hours is standard hours times the standard rate, which was $6 an hour here. Okay, so we do the multiplication and we get these numbers in the red. Again, taking the difference between the leftmost column and the rightmost column, 8,990. If you want to be consistent, by the way, with the formula method, then go ahead and take the leftmost column minus the rightmost column. So for the rate variance, it'd be the actual minus the actual hour standard rate, and you get a positive 290. And so just like using the formula method, a positive variance is an unfavorable variance. Okay, so it's kind of counterintuitive a little bit. A positive is unfavorable, whereas the difference between the middle column and the rightmost column is a negative 300. Negative is a good thing for variance analysis. So that's positive 300 favorable variance. Okay, and if we didn't ask it, but total labor variance is the difference between the two outside columns. So 8,990 minus the 9,000, that's a negative 10. So that's a $10 favorable total labor variance. And again, if you add up these two variances, you'll get the same thing, a $10 favorable. Okay, so the total variance is just about where we wanted it to be, just a $10 difference or variance. But the components, you can see, are quite different. Okay, rate variance means we paid more per hour than we intended to. Efficiency variance, 300 favorable. So we used less hours than we planned to. Those two kind of wiped each other out, netted each other. It's almost to be even, but it's $10 favorable. Whereas looking back at the materials, let's see what happened. It was the total variance was $630 favorable. And how come it was good? It was because the quantity variance was bad. 630 unfavorable total materials variances. And why was that? It was because of the quantity variance. We used more materials than we thought we would. That caused the negative total materials variance. We did well on the price. It's favorable. We paid less than we thought we would have to. We paid $3.90 versus $4, so that's good. But we used way more materials than we thought we would. We used 1,700 versus the 1,500 we were supposed to have used based on our standards. So that's the kind of thing that these variance analyses tells us in total, did we pay more or less than we wanted to for materials and for labor? And then it breaks it down into the two components so we can see why we went over or why we were under the standards for each of those two categories, materials and labor. Again, don't worry about the journal entries to record the labor variances as well. Oops. Okay, so we won't worry about that for this class. Okay, overhead variances, the third component of manufacturing costs. We have a standard overhead rate. So the standard overhead rate, we saw this in previous chapters, is the total budgeted overhead cost. So the total overhead divided by your estimated activity. So whatever the basis is that we're using to spread out the overhead, okay, that's the denominator. And that gives us a standard rate. Okay, and here's an example of the overhead variance. Overhead based on machine hour activity. So here's at different levels of machine hours. Here's the total overhead. So overhead variances are the structure is a little bit different than the direct materials and direct labor variances, in that this table doesn't align exactly like the previous two. But in overhead variances, your actual overhead is your leftmost column. The middle column is your flexible budget. It's the budgeted overhead at the actual activity. So you have to redo and the rightmost column is your static budget. Okay, so it's the overhead at your standard hours. So this was the budget prepared ahead of time, sort of. This is the flexible budget in the middle. So there's two variances for overhead variances: your budget variance, which is your actual overhead minus your budgeted overhead. The volume variance. Volume variance is your budgeted overhead at your actual activity minus your overhead at standard hours. So this volume variance measures how much more volume or less volume you had than you anticipated. Because remember, the more volume you have, the overhead spread out among more units. The less actual volume you have, the fewer units there are to spread the overhead over. The budgeted variance is how much you actually spent versus how much you should have spent at that same volume, kind of thing. Okay, Um, here's what those overhead variances mean. So budget variance is how cheaply we were able to buy the overhead, whatever was in overhead. And there's all kinds of stuff in there. For example, electricity, all those kinds of things. So how much less or more did we pay for those overhead items than we had budgeted? Okay, and how efficiently did we use those overhead? So like, did we use less electricity than we thought we would? Or did we use more electricity than we thought we would? Those are budget variances. Volume variances, and on the other hand, is looking at just the fixed cost. So if we produce more or less than we budgeted, that would spread out the overhead, the fixed costs over more or less than what we thought it should be spread out over. Okay, so those are the two different variances for overheads. Okay, so here's an example. So these guys made 1,600 zippies, resulting in 3,200 standard machine hours. So it looks like there's 2 hours, machine hours for each unit made. The actual overhead cost was $15,450. Compute the overhead budget variance and the volume variance. The actual overhead, this is given 15,450. Actual overhead 15,450. There's no need to break it down into the fixed and variable or the hours and per hour kind of thing. It's just in total. Let's go to the right hand side. The applied overhead at standard hours. So the standard hours was supposed to be 3,200. That's how many hours it should have taken to make 1,600 zippies. So that's the hours times the $5 an hour. The $5 an hour, well, the 1,600 actually is probably the easiest thing to look at. So let me see how I can explain this. Oops. They didn't tell you this actually in here, but yeah, they missed that. It should have indicated that the standard hours is supposed to be $5 an hour. Okay, that's missing from this thing. So that's a piece of information that should have been given to you. So the amount of overhead that is supposed to be applied based on the standard 3,200 hours should have been $16,000. The middle column is, and again, they don't give you all the information here. So, oh, here it is right here. Okay. So let me go back. This is a little bit confusing the way they present this, but the budgeted standard overhead is the 9,000 fixed overhead. So remember when we saw this flexible budget, the fixed overhead was 9,000 all the way across the board. Okay, and that's this 9,000. The actual hours, well, the $6,400 variable was based on, and again, they didn't do this quite right. You would have had to redo this flexible budget based on the actual overhead that was used. And remember, that was 3,200. They should have showed this, but they didn't. But if you were to redo this flexible budget using 3,200 machine hours, you'd notice that this would be, notice the ratio of machine hours to variable overhead was that $2 per hour thing. Yeah. Okay. So, anyway, the actual overhead minus this budgeted overhead, the 15,400 is the budgeted overhead, and that would be given to you in a problem. I could give you all three of these red numbers probably. Again, the difference between the left hand and the middle columns is the budget variance. the difference between the middle column and the right hand is the volume variance. Apologize for the way it was worded and presented. It wasn't really presented in a very good way, but just be aware that what these three columns are, and again, I would have given you for the overhead variances, at least these red numbers if this were given on an exam. So don't worry about so much about these details and where they came from. Just worry about the red numbers and the differences between them as the variances. Okay. Again, don't worry about the journal entries. Managed but by exception, just to recap the term, it's checking or investigating or following up on only those things that are not what we expect. And again, standards are what we expect. So we only look at variances that are different than what we expect. So, okay, that's what we look at. Disposing of variances. Don't worry about this unattainable standard thing. But generally what we do with variances, if the actual turns out to be different than what we expect, then we either increase our loss or we decrease our costs. So it goes to the income summary in any case. Okay, so don't worry so much about that because that's related to the journal entries. Okay, whoops. And again, don't forget that in addition to those financial variances that we saw, there are other non-financial performances measures that we need to consider. So sometimes it's more important to focus on customer service instead of just focusing only on trying to meet standards. So for example, good example is if we're making a product and the price of the materials goes up unexpectedly, we don't want to necessarily reduce the quality of the materials we're getting just so that we can meet the standard of how much we're paying per pound or per unit of material. I mean, that's great for meeting your standards, but then it results in poor quality because you're buying less quality materials. So that's no good. So you have to consider that as well. In the case of labor, if labor costs go up unexpectedly, we could still meet standards by hiring less qualified people, but then that would reduce the quality of your service. So whether you're making a product and using less experienced people, you might have a poorer quality product. If it's a service, if you hire less qualified people and pay them less and thus meet your standard, that will result in lousy customer service. So you don't want that either. So just keep in mind that it's not just the accounting numbers that we're concerned with, not just the variances. We have to look at other qualitative factors as well, yeah, instead of just only focusing on the accounting part of it. And that's chapter 8. The question for the weekly quiz on chapter 8 is, let's see, my favorite place to visit. Okay. I like to visit more than anywhere else, Las Vegas. That's my favorite vacation spot. Okay, that's the lecture on chapter 8. Aloha.